Okay, so here's a nice long cumulative FRQ that touches on a lot of different things from kind of the latter part of macro. So we're going to begin assuming that the economy is in short run equilibrium with the actual unemployment rate above the natural rate of unemployment. So we're at short run equilibrium, not long run equilibrium. That's important. And then our unemployment rate is above, it's higher than the natural rate. So, this basically means that we're in some level of recession. Okay? So for A, draw a correctly labeled graph with both the long run and short run Phillips curves. Labeled the short run equilibrium point P. Okay, so we know that for the Phillips curve, we've got the inflation rate on one side, and we have to do inflation. We can't do IR because that sort of implies interest rate. That's what that's going to be. And then we know that unemployment is on the bottom. So our long run Phillips curve is always going to be vertical, and then our short run is going to be downsloping. And we know that since we know from the question, the actual unemployment rate up here is above the natural rate of unemployment, that we're going to be here. Okay, so so say our natural rate of unemployment is about 4%, we're going to be higher, say 5%, and then our inflation rate will be lower than what is expected, right? So this would be our expected inflation rate, and this would be our actual inflation rate. You don't have to draw that in, but just a little bit more for you. Okay, if no policy actions are taken, we're into part B now. Will the short run Phillips curve shift to the right, which is up, shift to the left, which is down, or remain the same? So in the short run, if nothing happens, then that's basically the classical approach, right? Do nothing and let the economy work itself out. So what's going to happen then is it will shift to the left. Okay, now that's the what, and then our why is there's going to be downward pressure on wages and input costs. Right? So we know that a downward pressure pushes our short run Phillips curve back into the left because of these lower inflationary expectations and lower input costs. Okay, and that's just what is going to happen over time. It won't happen quickly, but that's the self-correcting nature of classical economics. The problem, of course, with that is it might take a very long time. Meanwhile, we have this GDP gap and a bunch of unemployed people, which isn't great. Okay, now we switch sort of out of the classical mode and get into a more Keynesian approach where the government decides that if it wants to intervene, what can it do? So if the Federal Reserve Bank, so that tells us we're talking monetary policy, wants to lower unemployment, what expansionary open market operations should it use? So since it's open market operations, we know that we're really just talking about bonds. Okay, you're not going to talk about the discount rate. You're not going to talk about reserve ratio because those are not open market operations. Open market operations is the buying and selling of bonds. So ultimately, are we going to buy bonds or are we going to sell bonds? The expansionary idea is to buy bonds. Okay, now we're on to D. So how will the open market operation that we identified in C affect the following? So the federal funds rate will fall, and that's because M will increase, reserves will increase, and that pushes the FFR down. Okay, and what will happen to the real interest rate? The real interest rate will also go down. That one there's no explain, so you don't have to. But for your purposes, you can remember. I'll even change the color so you know that this isn't mandatory. You've got your money supply, money demand. If you increase money supply by moving it to the right, then your real interest rate is going to fall. Okay, and buying bonds, of course, increases the money supply. Okay, back to E. Given your answer in D2, what will the effect on real GDP be in the short run? All right, so now E, real GDP will rise because interest rate sensitive spending will increase. So anything that gets purchased, that gets financed, is going to become cheaper because real interest rates go down. So that could be, an interest rate sensitive spending. There's a component of C, but of course it's largely IG. Okay, so that is that, and that's plenty of explanation there. Okay, now we get into a little currency stuff. So obviously, you guys didn't learn this in quite as much detail this year. But we know that Japan and the U.S. are major trading partners. That increase in real GDP, what's it going to do? Well, basically, the increase in real GDP means that Americans are going to be buying more stuff all over the place. They're going to buy more stuff made in the United States, and they're going to buy more stuff made in Japan. If we are going to buy more stuff that's made in Japan, we must demand more yen because we have to buy yen in order to buy Japanese stuff. Okay? So this one doesn't have an explain. I just explained it, but you don't have to do that. Demand for yen will rise. And then you get to draw that last graph. Okay, so remember A price of B quantity, A price of 1B quantity B. So we have the dollar price of 1 yen, quantity yen, demand for yen, supply of yen, and demand will rise. So the yen, and let's see if you have to, showing the effects of the change in demand identified in F on the value of the yen relative to the United States dollar. So as long as you have this arrow here, then you are good. But of course, what that means is the yen is appreciating against the dollar. And there you have it, guys. Have a good day.